Justdial is on our radar. The stock is surging on the back of good third quarter numbers. The company saw revenue growth of around 16.3% on a year-on-year basis, and EBITDA margins have also expanded to a 4-year high. We have Abhishek Bansal, who's the CFO of the company, joining in to discuss the numbers further. Mr. Bansal, thank you very much for joining in. Well, what stood out is definitely the margins, which have expanded to a 4-year high. What led to this, and is it sustainable? What's the guidance?
So we had a very good fourth quarter as well as full fiscal year where business was able to deliver on most metrics. I would define fiscal 24 as the year of efficiency for us, wherein we delivered growth in terms of the traffic top line in a very cost-efficient manner. So we had exit margin of about 26.1%. And for next year, definitely we are targeting that whatever was our exit margin, we could easily or comfortably have that level for the entire fiscal year. And in the past, business has delivered even 27, 28% kind of EBITDA margins.
All right, 27, 28%. So what we were wondering is whether that sort of margin is likely sometime in the next 4 quarters. You typically guide for 20% growth at the year, at the start of the year with 25% margins. That's what you did in FY23, at the start of FY24, that is. Now we're at the cusp of FY25. What are your thoughts in terms of revenue growth and margins that you're likely to do in this year?
So the target is to surely have 15% plus kind of top line growth, which would be very good in current environment as far as SME health is concerned. As far as profitability goes, the business has significant operating leverage. And as I mentioned, while we have mentioned that the endeavor is to have 25% plus margins, but last quarter itself, we were at 26% plus. So once we reach that kind of 27, 28% kind of margin levels, we will take a decision on whether to deploy part of incremental margins into advertising, which will boost my traffic and aid my monetization in subsequent quarters and years, or retain it as it is.
So 27, 28% likely in the first half of this year, given the operating leverage and 15% growth that you're guiding for?
Yes, that is possible. But as I mentioned, that as we go into future quarters, we will decide what kind of advertising spends we wish to do.
Okay. All right. Fair enough. You will decide what kind of ad spends, but that's also contingent in terms of the kind of competition that you're seeing. So if you could just give us more qualitative, maybe even quantitative information in terms of what the competitive scenario is with the likes of Google, Meta, how is that shaping up for Justdial at this point in time?
See, for us, there is no direct competitor per se. When my salesperson meets SME, there is never a discussion that whether they would want to invest with Justdial or any other platform. There is definitely competition in different buckets, but despite all the competition that has played out over the last decade, we have 170 million unique users on a quarterly basis. The business is doing 1,050 crores of top line as we saw. So we don't bother much about competition. Whatever is there, it is there. And the endeavor is to grow our top line and profitability.
Okay. So what do you think would probably be the biggest headwind for the company going into FY25? The biggest risk to your revenue, the biggest risk to your margin?
So the biggest risk that I would say is that while we are already at about 25, 26% plus in terms of traffic, we had about 7, 8% growth. So as I mentioned earlier, that we will take a decision on how much we want to spend on advertising. So it's a call between advertising spend versus the level of margins that we wish to operate. So accordingly, we'll take a call as we go forward.
When you say take a call, what does it mean? Over and above the 3-4% that you're spending already, or you will take a call from point zero and say that, okay, this is what we'll spend? Just wanted to understand. This 27, 28%, if you're crossing the margins by, say, 1% or 2%, does that mean ad spends go to 5%, 6%? Can you explain that in detail?
Sure. So last year we spent about 21-22 crores on advertising. For achieving even say 27-28% kind of margin levels, I can easily up my ad spend to even 30-35 crores and still be able to achieve those kind of margin levels. But in case I see my margins possibly expanding further, I might take a conscious call to up my advertising to even overall 4 to 5% of my top line or even higher.
Okay.
And when will you get clarity on that by?
So we spend about 5 to 5.5 crores on advertising on a sustainable basis. As and when we go into future quarters, we will keep calibrating our advertising spends. So I don't think it's a matter of a specific point in time where we say that, yes, we need to spend. In a calibrated manner, we will grow our advertising spends in line with how the rest of the business is panning out.
Okay. Just to maintain this margin, which you've already achieved, any further cost cutting that the company is contemplating in FY25? I think you already reduced your sales strength. It was down around 5% on a Q-on-Q basis. Any more such reductions, any more cost cutting that we can expect from the company?
So what we did in fiscal 24 was more about cost optimization rather than absolute cost cutting. What I mean by that is, for example, in our non-sales departments, deployment of tech and automation has helped us automate several tasks which required manual resources earlier. Similarly, in Salesforce, we have tried to focus on hiring better quality talent rather than, say, focusing on quantity. So those kind of initiatives are what has helped us maintain our cost, at the same time have better output, which is what will be the endeavor for fiscal 25 as well.
Okay, so you are seeing possibly AI take over a lot of your manual operations. Is that what you indicated?
Yes, so part of our work around content enrichment, etc., is getting a boost from automation, whether it be AI or other technology tools. So that definitely is aiding us in automating some of these initiatives.
Cash on your books. That's the perennial question, you know. What's the plan with that? At the end of this year, what does it stand at on a net basis? And what's your deployment plan here?
So 4,625 crores is the cash on our books at this point of time, which is deployed in about 7.2% pre-tax, yielding safe, efficient returns. So focus currently is on growing free cash flows. And as and when there is a conscious decision taken to either deploy or distribute this particular existing cash balance, we will obviously communicate.
4,600 crores is nearly half your market cap. Nearly half your market cap deployed in 7.2%, instruments while you focus on generating more cash. The street would have liked some more aggression when it comes to, maybe looking at inorganic opportunities, etc. as well, right?
So I think let us look at it this way. Either we could look at certain, say, inorganic opportunities, or possibly aggressively spend this money or deploy this money in aggressive advertising, etc. But what we find is that, one, we are very clear that whatever initiatives that we deploy to should have positive unit economics over medium to long term. Second, even in terms of any inorganic opportunities, just for the sake of investing, we have never taken such decisions in the past. We would rather have that cash on an efficient, safe return. But having said that, as I mentioned, that as and when there is a decision to deploy or distribute this particular treasury, we will accordingly communicate.
But at no point will you look at giving it out to shareholders, because you said even if you aggressively spend on advertisements, that's you do about 35 crores. You do a little more than that as well. Double of that, that will still be just 2% of your cash. So, if
Right,
you're sitting on so much cash, yeah.
So as I mentioned, both deployment and distribution, both options are completely on the table. And any decision obviously will be taken to ensure it is value accretive to all shareholders.
What is the kind of acquisition that you would probably be interested in? if that is the case?
So in case we were to evaluate any acquisition, it would be any particular synergies with our core business, local search, any tools or technology which could help us add more value to SMEs, any particular products which could enhance stickiness of customers with us. So those could be some of the areas which we would explore.
All right, we take that point. Just one quick question. Your other income per year last year was just about 9 odd crores, so rather 300 crores. So you basically recognize all the yield that you make on the cash that you have on your other income in the books, right?
Yes, so our treasury primarily is deployed in majority is deployed in debt mutual funds with about 3 years of duration. And basis mark to market, whatever are the MTM gains, we recognize them in quarterly P&L. Part of the treasury also earns tax-free interest income that also accrues every quarter.
Okay, all right. We're going to leave it on that note. Pleasure speaking with you, and congratulations again on what has been a good quarter. So that's Justdial, stock up around 10 odd %. Need to take a short break, but once we are back, we'll be talking tech.